Hi, Alexis.
Hello, good afternoon.
Good to see you. Have you been here before?
So this is the first session that I'm attending because last week I had scheduling issues with work. So this is
Oh,
gonna
okay. Have you been watching the replays?
yeah, I watched the replays on the links and the modules.
Okay, okay. You can also find them on my YouTube channel, the Bob Smagula YouTube channel, and along with some other silly stuff. Hi, Kaylee. How you doing?
Hi, Bob. I'm good. How are you?
All right. You want to show your face today, Kaylee, or are you hiding?
I am gonna hide today just because I'm snacking while we're lecturing. Sorry.
I've been snacking every minute of my life. It doesn't bother me. Okay. All right. This chapter is going to be really a quick one. And it doesn't have much to do with the numbers. It's more of about some of the regulatory agencies and some of the background of the accounting world. Now, let me tell the class that when we get done with this chapter, we have a test coming on Tuesday. Okay. That means that we can use the Friday class for a very good test review. Okay. So I recommend that people show up for that, and I can, give you some good pointers how to navigate through there. Okay. So let's see what we have here. Can you see the PowerPoint, Alexis?
Yes, I can see it.
Okay. Because I don't want to make that mistake I make before where no one sees the PowerPoint until an hour into the class. Someone says, shouldn't there be a PowerPoint up there? Okay. All right, here we go. Chapter 5, communicating, interpreting, accounting information. Here's something I'd really like you to learn about, because if I was making the test up, I would have at least 2 questions on Sarbanes-Oxley Act. Sarbanes-Oxley, Paul Sarbanes, and I think the other guy was James Oxley, 2 congressmen. In the rush to regulate after the great Enron scandal of about 20 years ago, Sarbanes-Oxley is a law that strengthens the financial reporting and corporate governance for public companies. It used to be that a company would turn out financial statements and they would be wrong sometimes. Sometimes they were wrong by mistake, honest mistake, but sometimes they were fraudulent. And guess what? The owners of the company, the corporate big shots, they could throw up their hand and say, "Hey, I'm not the accounting people. I didn't do it. Alexis did it. She's the accountant." They would blame somebody. So now with Sarbanes-Oxley Act, they are actually required to attest that they read their financial statements and they understand them. Sarbanes-Oxley, a very overdue, powerful law that came into existence after the scandals of the late 1990s. Players in the accounting process. Okay, let's take a look here. Management is responsible for the financial statements. Management, nobody else. Those statements are going to be prepared based on what the auditors and board of directors do, following the rules of the SEC. Securities and Exchange Commission, that's the stock market. That's the New York Stock Exchange, the over the counters. You cannot list a company on the Security and Exchange Commission on the stock market unless you have audited financial statements. Okay. And those financial statements must be done on the basis of the FASB. Here's another mnemonic I'd like you to understand: FASB, FASB, Financial Accounting Standards Boards. They're the ones who make up the rules of accounting. Whenever you hear about the principles of accounting, it's the FASB group that measures them up and makes them put into play. So you have a board of directors and auditors who have separate but very important duties in making sure that the financial statements are correct. The auditors are external people. They have nothing to do with the company. They come in as independent auditors and make a judgment on the quality of your statements. The board of directors is a combination of a few people from the company plus outside board members. And altogether, these are the three managers of the financial statement reporting. The SEC, here we go, Securities and Exchange Commission. It began, let's see if they talk about it more. I'm a history buff, so I'm going to talk about it a little bit. The Securities and Exchange Commission, it protects investors and hopefully maintains the integrity of the securities market. The Securities and Exchange Commission came into existence in 1933 with the election of President Franklin Delano Roosevelt. The country was coming out of a horrifying depression. Wasn't coming out of it, they were smack in the middle of it with the worst to come. And what part of what the problem was with the depression was companies were putting financial statements out that were totally false, and there was no real regulation. You would look at a company's financials and say, hey, they're doing great, when it turns out maybe not. So the Securities Exchange Commission set up some rules starting in 1933, 1934, that said that financial statements have to be independently audited, and they must be done on basis of GAAP accounting as started by the Financial Accounting Standards Board. Who is responsible for the financial statements? Management of the company is management. Managers are responsible for the information in the financial statements and disclosures. And we'll talk about disclosures in a moment. Well, the CEO is the highest ranking person in the company. He or she, they have to sign off that they read their financial statements and understand them to a reasonable degree. The chief financial officer, the CFO, highest officer associated with the accounting side. The accounting staff prepares the details of the reports and also bears professional responsibility for the accuracy. In other words, if your accounting department gives you bad information and you don't catch it, well, it's management's job to kind of catch that type of thing. But the accounting staff bears some responsibility too for the quality of the statements. Board of directors. This is a group elected by the shareholders, the stockholders, okay? The board of directors, they have three main jobs from what I can tell. The board of directors are the ones who decide if a company is going to pay a dividend. And they also are the group that will hire the auditors through an audit committee. So the board of directors, they're the ones who will hire the auditors, and there's usually an audit committee of the board responsible for maintaining the integrity of the company's financial reports. And even the board of directors have been involved in some chicanery, some cheating, where an officer of one company says, I'll serve on your board if you'll serve on my board, and then we will just ignore the problems. So the board of directors, they need to maintain their independence and honor. Independent auditors. These are your big accounting firms. Deloitte Touche, I believe it is one of the big ones. Pete Marwick was a big one. Arthur Andersen was a big one. Many of them went out of business with the scandals, and it's a very fascinating period of financial history. Independent auditors, they follow the FASB standards to assess the fairness of the financial statements and related presentations. What you're looking for as a company is what's called an unqualified opinion. Unqualified or clean opinion. It states that the financial statements are fair presentations in all material respects in conformity with GAAP. Now, does that mean that the financial statements are correct? Not necessarily. The auditors are not the ones responsible for defining that the financial statements are correct. They're the ones who said, based on our procedures, based on our tests, based on our questions, based on our knowledge, these statements are fairly represented according to GAAP. Okay? Again, management is responsible. These are the computer guys, information services, financial analysts. And we'll look at this briefly. I've not really done anything with this slide before, but most companies, they have a website, and potential customers, lenders, investors rely on that website. And these companies file their SEC forms electronically, which is sponsored by the SEC. Not too much there for us. Wow, look at all this stuff, huh? Here is just one Google hit. Looks like if you just Google NASDAQ and then you put in Apple, you get all the possible information you could want about the company. Now, I don't know what the date of this was. I can't tell from here. But at the time, Apple was selling, the price of the stock was $618.70. And it had a bad day. It lost $14.60 that day. And they're giving you what its stock had been trading at. For the past 52 weeks, this stock was trading between 310 and 644. In other words, this stock more than doubled. It got as high as 644, came back down to 608.17. They're showing you here how it moved throughout the day. You notice that it was bumpy for a while and then a steady decline at the end of the day. And then here, you might notice at 3 o'clock when the market closes, you see a little uptick there. So that might encourage investors that the stock will bounce back the next day. My point is there is so much information out there about a company that you might want to invest in. Apple, $608.17 a share. They later split that stock. They split the stock, about 10 to 1. And a stock split, you're going to learn all about in a future chapter. But a stock split or a stock dividend is this. You own one share of stock at $608. We split it into 10 shares where they're only worth $60.80, but you now have 10 shares, so you didn't lose anything. And the reason companies do that is to attract smaller investors. It's psychological. People say, I can't afford $608 a share. Well, you can buy a partial share, but typically you think of investing in terms of 100 shares. Who are the users of all this information? The institutional investors. These are the big guys, the Goldman Sachses of the world, what used to be Lehman Brothers till they went out of business in the run up to disaster in the late 90s. Institutional investors. These are the pensions, the mutual funds. These are the big guys. These are the people who go out and buy millions and millions of shares, and they are the market movers, if you will. If a big pension fund goes out, they'll go out. They're not going to buy 100 shares of Apple. They'll buy 1 million shares, and in so doing, drive the price of that stock. Institutional investors. Pension. I get a pension now from where I used to work. And that pension is part of the institutional investing. My former company, gave that to a place like Goldman Sachs and said, invest it as best you can. Private investors, that's you and me. We go out and we buy stock in a company. We go out and we buy 100 shares of Coca-Cola, and hopefully we collect some dividends. Right now, Coca-Cola pays about a 3% dividend, which is pretty good compared to what you'd get at a bank, which is less than 1%. And hopefully Coca-Cola has some upside with the price of the stock. Private investors. And you guys are young. You could call up any stockbroker in town right now and introduce yourself and say, look, I'm going to City College. I hope to transfer. I'm majoring in business. I have just a little bit of money. I'd like to start investing in stock. Are you interested in taking my business? They would jump at the chance to do that because they want you to be with them for the next 60 years. Okay. And you could start small. You buy 100 shares of something and see what happens. Lenders or creditors. Man, oh man, no one is going to loan a company money unless they have accurate, tested, audited financial statements. No one's going to loan you money. No one's even going to ship you a product. No one is going to ship your raw materials to you. unless you pay them COD, and that's no way to run a business. Commercial credit companies, these are the companies who rate a business in terms of their bonds, whether they're risky, whether they're safe, and you want them on your side, and other financial institutions that lend money. So the institutional guys are the big ones. The private investors are you and me. The lenders or creditors are the people who are going to do business with the company, and they want to know that the company is in decent shape. Disclosure. This is interesting. SEC regulation, FD, fair disclosure. Companies must provide all investors equal access to all important company news. Okay. Pfizer, they came up with the cure, not the cure, but the vaccine for COVID-19. Well, when they did that, they didn't just tell some of their big investors, say, hey, I got great news. Our vaccine works. It's going to be approved. And that means big business for us and a big stock increase. No, they have to announce that pretty much to the whole world at the same time. I mean, they're not guaranteeing everybody gets the information at the same time. So the fair disclosure is everybody gets a shot at the same information. It's a level playing field. Insider trading. You've heard of insider trading, Alexis? Insider trading. This is a situation where you work for a company and you know that in 2 days, this company is going to merge with another company. And you know when that happens, the stock in your company is going to go way up. You know that because you're an insider. You're the one working on the deal. You are not allowed to buy stock and benefit like that. That's called insider trading, and it's illegal. You cannot do that. It's part of being, everybody disclosed together. You cannot trade, inside trade, based on non-public information. If you know something that only you and the company knows, you guys in the company can trade on it. You know Martha Stewart, Alexis? You know who Martha Stewart is? She's she's my old buddy from New Jersey. She's a fellow Polish lady from Nutley, New Jersey, where I grew up. She's one of the richest women in the world, right? She's worth hundreds and hundreds of millions. She went to jail for a year for insider trading. Do you recall that? Maybe you do, maybe you don't. You could Google it. She went to jail for insider trading. What happened was she had an investment in a drug company, and the president of the drug company got bad news that the drug test failed, that their breakthrough was not going to happen. So the president of the company knew that the next day the stock was going to go down. So the president of the company did something terribly illegal. He called Martha Stewart and told Martha Stewart the bad news. She immediately violated the insider trading rule by calling from her private jet, which makes it look even worse. And long story short, Kaylee and Alexis, she saved $32,000. She went to jail for what is for her a tiny amount of money. Insider trading, no can do. This is always funny. The press release, a press release. Oh, everybody's waiting for the announcements of earnings. You might, if you're ever flipping the channels on television or you're on the radio and you hear the news a little bit, you might hear somebody say, Apple today announced record earnings, or everybody's waiting for Apple tomorrow to announce to the world what they did. And they send out what's called a press release. Every newspaper in the world practically gets one of these things. They put it on their website, and they're going to make it sound like they're the greatest company in the world. Like here, Apple, all-time record iPhone, iPad, and Mac. Apple today announced financial results for the first quarter, spanning 14 weeks. The company recorded quarterly revenue of 46 million, profits of 13, and then they compare them to last period. How much better? In other words, it's half financial information, and it's also half of a plug for the company. So that's how you might find out about how good things are going. And then on the bottom, the president of the company, Tim Cook, he's the guy who took over from Steve Jobs when he died. We're thrilled with our outstanding results and record-breaking sales. Apple's momentum is incredibly strong, and we have some amazing new products in the pipeline. The press release. The disclosure process. How do we disclose things? Well, we disclose things by announcing it to the world at the same time, and also in the financial statements, okay? You have 4 basic financial statements. You have the income statement, equity statement, balance sheet, cash flow statement. Each of these statements are going to have notes, and the notes are just as important as the numbers. And you're going to have notes for just about every category of numbers. So the notes are one way to disclose. And then you have the auditor's opinion. Remember, we wanted to get that unqualified opinion. Once you have that, you send that out to the world and get the word out that your statements are good. And that's done with a Form 10K. It's the annual report. You don't have to worry what the 10K is, but it's the annual report that publicly traded companies must file with the SEC. And that thing is giant. Now, when we get through with the test, you're going to get what's called an FSA assignment, financial statement analysis assignment. I'm going to pick 2 companies in the same industry, and you're going to compare them in all kinds of different ways. And you're going to do that by going through their annual report and the 10K. That's coming up after the test, okay? When we get to chapters 6 and 7. I was hoping they had more on the notes here. Maybe we'll go back to it. A closer look at the financial statements. 3 additional characteristics of financial statements. Typically, they're comparative. You'll have in column 1 the balance sheet from 2020, and next to it the balance sheet from 2021, and you strike the differences. Wow, cash went up, and there might be a note explaining why cash went up. Accounts receivables went way down, which is actually a good thing, and they'll talk about that. And they'll put some subtotals, different classifications. Don't be confused when you notice slightly different statement formats used by different companies. And like I said, with the notes, most companies present voluminous notes that are necessary to understand a company's performance and financial condition. The notes. Let me take a shot of my whiskey here. Oh, that's good whiskey, not soda. I'm going to get in trouble one of these days with that joke. Disclosures, a lot of notes. Here's what we're talking about, comparing the 2 balance sheets. You know, you can look at this and say, cash went down by about $1.5 million here. That's something you might want to look at. Let's see what receivables did. Receivables went down about the same. And you pick out some of the big difference, what's going on here. I have no idea what this is. Vendor non-trade receivables. I'm not sure what that is, to be honest with you. But that's a big number, whatever the heck it is. So if they're just comparing the 2. Here, they're comparing 3 years of the income statement. Let's see, you invested in this company, right? Well, when you invested in 2009, the sales were 42 million, and they grew almost 50%, and then they grew another 50%. So look at this. This company, Apple, has been growing like crazy. Now, admittedly, this is 10 years ago, but believe me, Apple's still in pretty good shape. 9, 10, 11. You can do some comparisons. Let's see what their operating income was. Operating income went from 11 to 18, 33. Wow. Sales went up about 2.5 times. And in so doing, their operating income went up nearly 1/3. So this is a company that seems to know what they're doing, huh? Earnings per share, $9.22, $15.41, etc. If you're a stockholder in Apple, You could look at that $15.41 and say, hey, maybe they'll give me $15 dividend for every share I have. Or if they don't do that, they use that money wisely to develop more products and really raise the price of the stock. Non-recurring items. These are called extraordinary items. The proper term is extraordinary items. These are things that do not happen very often. They have really nothing to do with the operation of the company. It's just that we're stuck in a situation where we have to take a hit or maybe even pick up a gain on something totally unrelated to running the business. Income statements report non-recurring items separately because they're not useful in predicting the future income of a company. The classic example every textbook makes is discontinued operations, okay? Where I worked for a number of years was with a company called Thomas and Betts. And I was with a very small division downtown LA. And the main company was a big giant company. My little world was small though. And Thomas and Betts might have made an announcement where they say, we are going to close the Pennsylvania factory. We're closing the Pennsylvania factory. It's not profitable. It's an old building. We're sorry, we have to let people go. That's a discontinued operation. You don't include that with your normal reporting because it has nothing to do with the past or the future. It's going to skew your comparisons. So it goes below. And then you could have other extraordinary items. The disposal of a fixed asset used to be considered extraordinary, not anymore. So non-recurring items. Now, when we get started on the FSA, you're going to do some metrics, okay? Earnings per share. Earnings per share. Net income divided by the outstanding common shares. Let me repeat that. Earnings per share equals net income divided by the average number of common stock shares. That's simply the number of shares at the beginning plus the shares at the ending divided by 2. Income per share. Earnings per share. This is one of the first metrics people look at when they're deciding to invest in a company or loan money. How much money are they making for their shareholders? Here's one you've already been doing, I believe, a little bit. The gross profit percentage. Gross profit. Gross profit divided by sales. And you can have net profit divided by sales. Gives you a certain percentage. If you have a gross profit percentage of, say, 20%, that means your company is generating 20 cents of profit for every dollar of sales. Here's a statement of comprehensive income. This we're not going to get involved in this too much at all. I'm kind of smiling because this is goofy stuff. Comprehensive income. These are the far out things that have nothing to do with running the business, but fair value change on available for sale investments. We've got that coming. We got a whole chapter on that coming up later. Fair value on cash flow hedging, actuarial loss. Yeah, we don't really do things with this, but these are examples of other types of income. Currency translation difference. We have a big factory in Iran, and then the value of the Iranian ruble or whatever it is collapsed. We have to show that as a loss here. Actuarial loss from pension benefits. When you're born in this country today, your life expectancy for a male, I believe, is 79 years old. You're expected to live 79 years. As you get older, you're expected to live a little bit longer. And actuarial people are always looking at pension plans, looking at the ages of the survivors and figuring out how much money they need there. So we're not going to do much with this until chapter 10 or whatever. Look at your equity statement. we finally see a financial statement here. Look at your equity statement. We have stock, shares. Remember that this amount here is always your shares times the par value. So they issued 915,000 shares. Then they issued some more shares. And as of September 24th, 2011, a year later, they have 929,000 shares outstanding. Whoops, hold on one second here. Outstanding at a value of $13 million. Retained earnings. Retained earnings. Understand what that is. That's part of equity. It has a normal credit balance. Retained earnings. That's where all of your net income is rolled up at the end of each month. Business starts on January 1st. By definition, there are no retained earnings. You make a profit that first month of $10,000, that goes there, 10,000. The next month you made a profit of 26,849. That's how you ended up with the 36,849. So a little review of what retained earnings is. I think that's always useful. Retained earnings increases with the profit, decreases with a loss, and it'll also decrease with dividends. And we have a lot coming up on dividends. So your total equity in this company is $76 million. Statement of cash flows. Again, you keep hearing me say coming up later in the course, which is only like 3 weeks away from being done. But we'll get to this. Operating, investing, financing cash flows, okay? We're not going to worry about that right now. Other than financing cash flows, that's borrowing money, that's raising money through a stock issue. Investing, you bought stock in another company, or you bought another company's bond, or you bought a big asset, like a truck, big machine. Operating is everything else, everything that's required to run the business in the way it was supposed to be run. Coca-Cola, my favorite example, all what their job is buying raw materials, making soda, bottling soda, selling things, paying for things. That is operating. And here is a consolidated cash flow statement. Again, this is in your future, but I'm just going to show you one thing. Notice what the cash balance was at the end of the year. The cash, I want to see if they laid this out correctly. Yeah. For example, in 2010, 2009, the cash was 11,261, and it went down, it looks like, to 5,263. And they're showing you that even though cash went down, operating generated a big number, but they invested a lot of money and they had to pay back some debts. That's just a quick, I'm not sure that was very useful, but when you get into the next chapters, it will be, we'll go over it. Look at the notes. Hey, we're back to my favorite subject, the notes to the financial statements. They add detail. They describe what the company's doing, and they're relevant, and you don't see them on the statements. Here is a perfect note. Property, plant, and equipment. Okay, $10 million, whatever it is. Look at the note. Our property, plant, and equipment are stated at cost. We use the straight line method of depreciation. And they're telling you, if it's buildings, it's 30 years. If it's an underlying building, up to 5 years for equipment, and the shorter of lease terms. So that gives the investor a little more information. And here is where they're giving you the detail. Here's your land and buildings. Okay, land and buildings, that's 30 years, huh? All right, and machinery, that's 5. You can glean some information from these notes. Here's another disclosure. A company might be sued by somebody. If there's a chance you're going to lose that lawsuit, you have to show that as a commitment or a contingency. And that's what they're doing here with some other kind of activity. They had outstanding off-balance sheet commitments for outsourced manufacturing, computer opponents. They have to announce that to the world via note. And then you have voluntary disclosures, things you don't have to tell the world, but you want to tell the world because you think it provides a good look at your company and makes you look as good as possible. Whoever this company is, apparently they make desktops and portable furnitures. Oh, no, we're back with Apple. I'm sorry. That's a desktop computer and a laptop. Well, here we go. 36%. Their sales of portables went up from 18% to 36%. Their net sales went up from 13, 17, 21. So they're running pretty good there. Total net sales. This tells the world what they're selling, what they do. They have iPods, they have other music related things, iPhones, but the two big ones are the desktops and the portable. Now, again, this is 2011. I imagine desktops have fallen down into this category and the iPhone bounced back up in that category up there. International accounting, we're not going to worry about the international. Okay. Believe me. Here's another metric. I'm not going to go over it other than just briefly explain it. Return on assets, net income divided by your average assets. That's another metric that is very useful. Have you ever heard of ROA, return on investment, Alexis? That expression? Return on investment. Return on investment. You're going to get a turnover of your assets and multiply it by the net profit margin to get the ROA. This will come when we do our FSA, starting in about a week and a half, okay? And I'll go over these in great detail with you. How transactions affect ratios. Journalize the transaction, what account belongs. What they're just saying, what this is all about here is you have a ratio that exists. What happens if we change one of the numbers in the ratio? How does it affect everything else? And what do we have here? They incurred an additional $1,000 in research and development. We debit research and development expense and we credit cash. What would this do to our net profit margin? Well, our net profit margin was 23%, 23.9. Now we have this additional $1,000 of expense. It reduced our net income, so therefore it reduced our profit margin. Here's another one here. Here's another one. They're showing you with slightly different numbers. It reduces your net income by 1,000. In this one here, we have a transaction that's going to reduce our assets by 1,000, but it doesn't affect the beginning total assets. So what we have here is a reduction of 1,000 in net income, but the assets only came down a little bit. So our return on assets went down just a little bit. They paid 2,000 of accounts payable in cash, paid cash. So your assets went down and your liabilities went down. So now you have fewer assets to cover. That means that your ratio is going to improve. And that's the end of the chapter. Like I said, there's not, I mean, this, we sat here for what, about 40, but we did a little over a half hour here. Not much in this chapter, but a lot of it is setting you up for after the test, okay? So on Friday, I will conduct a test review. I'm not going to go into chapter 6. I think it was a good idea to get one chapter ahead. Sorry for those people who don't like it, but tough luck. And then we'll have our test on Tuesday. You're on your own with that. And then Wednesday, we start getting into the good stuff. So far, what you've seen here is mostly 110. Now we're going to get into the 230 work with receivables, and we'll go from there, okay? Any questions, Alexis? Anything you want to talk about? Are you around here, Alexis? Are you from around here?
I used to live in Santa Barbara, but I live in Santa Maria currently.
Oh, Santa Maria. Hello. Is that where you are right now?
Yeah.
Santa Maria. All right. I had to drive all the way up there for my COVID vaccine, but I was glad to do it. What do you think, Kaylee? Did we put you to sleep here? Are you okay?
No, I'm still here, still listening. I
Okay.
do have a question for you. On Monday, are we gonna have a lecture as well or no?
To answer your question, yeah. I'm
Okay.
just not. That's right. The test is Tuesday, so we have 2 classes before the test, huh?
Right. So I wasn't sure if you were gonna do another review on Monday or if we were gonna do chapter 6.
I'll probably go into chapter 6, even though we're not
Okay.
testing on it the next day. I'll double check with Cornelia how she wants to handle that.
All right, sounds good.
That's a great question. What makes it difficult is the truncated nature of the semester. We're only
Right.
here for like trying to jam. It's like, you got 10 pounds of bologna, putting it into a 1 pound bag, so. All right. Do you make a motion to end the meeting, Alexis? Alexis says yes. Let's get out of here.
All
Okay.
right, sounds good. See you
Hey, you
later,
guys,
Rob.
You
see
guys.
you later. Bye-bye.